Ever since Opportunity Zones first came out in 2017, we've been tracking the legislation, the ways that it's grown and changed, and perhaps most importantly, how people are taking advantage of the tax breaks offered by this program. And at Millionacres, we get dozens of questions about what an opportunity zone is, what makes an opportunity zone, and why it matters. So if you've heard about this topic online in other circles, sort of wondered what it's all about, we're going to break it down for you and discuss what we know. You are listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing and build real wealth. Hello, I'm Deidre Woollard, and this is the Millionacres Podcast, and today we're going to talk about all things opportunity zones. So there are currently over 8,700 of these neighborhoods that are all around the United States, and it's really a program with wide-reaching implications for a large variety of investors. So I wanted to bring together sort of by super team of Millionacres contributors. This is a panel of real estate writers that you've probably seen on the site, and they're going to help me kind of break down some of the questions that we've heard and get some guidance and really understand what this category is all about. So at our table today, we have three amazing Millionacres contributors: Liz Brumer-Smith, Matt Frankel, and Kevin Vanderboss. I'm excited to have you guys here with me.
Great to be here.
Thanks for having us.
Hey, thank you.
Excellent. So, Matt, I'm going to start with you. You are definitely one of our most prolific writers on Millionacres, and you've done a lot of the Ask Millionacres questions, which I really appreciate because it's a chance for our readers to send in questions and get them answered. So you've probably heard this a lot. Let's just start with the basics. What is an opportunity zone?
Well, first of all, thank you for calling me prolific. I like that word. But I do think on our site, Liz is probably the most prolific when it comes to opportunity zones. So we'll leave it with that. An opportunity zone, you kind of gave a quick intro. These were formed in 2017 as part of the Tax Cuts and Jobs Act, the big tax reform plan. That's most known for the lower tax brackets, the expanded child tax credit, things like that. So this came out of that same legislation. An opportunity zone, it's the point is twofold. One, it's a way to revitalize our lower income neighborhoods in the U.S. As you mentioned, there are about 8,700 of them that have been identified. They're defined as places that have either 80% or less of the surrounding area's median income or a poverty rate of 20% or more. Like I said, there are 8,700 of these. So this is not, they're not rare. They're not hard to find. The other reason they created opportunity zones is to allow investors to save money on taxes. It incentivizes, we'll get into the actual tax breaks in a second, but this incentivizes investors who have large capital gains and don't necessarily want to pay taxes on them, because who does, to invest in the communities that really need to be invested in. So like I said, I don't want to get too many specifics on the tax breaks just yet. We're going to do that in just a second. But that's the overall idea of what an opportunity zone is. It's a way to invest in our lower income communities while saving a buck at the same time.
Thanks, Matt. That's a great way to start. I think another thing that people are a little bit confused about is who they're for. So a lot of people think maybe you need to be a millionaire to take advantage of it. And so one of the questions that we've gotten is should I open an opportunity zone? Should I invest in one? What is that like? So, Kevin, I was wondering if you could explain a little bit about how it's used, and one of the things that I think people are confused about is the capital gains aspect of it.
Yeah, absolutely. So there's, I guess, two ways to go about essentially investing in the opportunity zone, whether that's, start your own fund and do the project, or invest more passively. And I guess the route anybody goes would, depend on, how much capital gains they really have to try to defer, and what kind of role they want to play in it. So, to invest in an existing fund, the major advantage there, I think as Matt was talking, is the deferring the capital gains, which, opposed to other types of real estate investments, when it comes to the deferment, they can come from anything. So it doesn't necessarily have to be like a 1031 where you sell a property and you want to defer those gains. It could be, from anything else, such as, stocks and whatnot. And the other benefit, I guess, to either side, though, besides those tax benefits, mostly, let's say the developer, on the developer or the investor side, putting the fund together, doing the project, is, from what I've seen, a lot easier to get the local community, the city, whatever municipality you have to work with behind it, because it's a benefit to the community, obviously. And that's, very helpful in getting projects done, as anybody who's been involved with any sort of development knows. The municipality can be one of your biggest hurdles. And in getting investments as well, you get a lot more publicity doing some of these opportunity zone developments. And other people in the community want to help revitalize it. Other people have a stake in it as well, not just as far as the profits go from the deal itself, but the local community, businesses nearby, other real estate investors that hold properties around there. Anything that can be done to help the neighborhood is a benefit for everyone. So, from what my experience anyway, collecting investments, raising investments is, been a lot easier when it comes to the opportunity zones.
Well, I think you make a really interesting point there about the publicity, because that's certainly one of the things that, as someone who sort of watches the market, I've seen every time there's an opportunity zone fund or there's an opportunity zone project in a neighborhood, you get the local media involved. People want to know more about it. People are really interested in what these projects mean for the neighborhood. And you're right that there also is that government involvement, partly because the opportunity zones, I believe, were originally chosen by the states themselves, so they have that investment as well. So, Liz, I wanted to switch to you because you wrote our Opportunity Zone Hub on Millionacres, and it's definitely one of the most comprehensive guides to opportunity zones that I think is out there. Of course, I'm biased. But if you want to find an opportunity zone in your area, what's the best way to do that if you're an investor who wants to join in on a project?
So I definitely think the easiest way to participate in opportunity zone funds is going to be the more passive route, where you take your qualified capital gains, rolling it into a qualified opportunity zone. And those are already designated, approved opportunity zones that have established plans in a designated zone. There are zones all across the United States, and the fund does not necessarily have to have the base or their operations in the area that they are investing in. The only requirement is that 50% of the investment is going into a dedicated opportunity zone area. And that can be in a number of different ways. So you'll find there is a wide variety of different funds to participate in a variety of sectors. What's happened this year definitely has thrown a curveball. So if you're looking for an opportunity zone fund to invest in, I would definitely suggest going to the EIG, which is the Economic Innovation Group, So I would suggest going to the EIG, which is the Economic Innovation Group. They pretty much are the hub for all things opportunity zones. They are really in charge of kind of managing everything that's happening with opportunity zones. They have updates on what's going on with the opportunity zones. They're tracking its progress, its success, potentially its failures. And they actually have maps that you can see where the funds are located, where fund activity is happening. They also share insights onto who are some of the more successful markets or funds in this space. So I definitely think that's a great resource for trying to find a fund to participate in. You can also narrow it down by sector too with their map, which I think is really helpful, especially with everything going on. You might be interested in a particular area, but if the only investment in that area is potentially struggling in the current marketplace, then you might want to look at a different investment elsewhere.
Well, that's really interesting, too, because one of the things that we've seen is construction sort of paused when COVID-19 when the outbreak began, and now has ramped up again. But there is that concern that some areas are coming back slower than others. Would you want to invest in an opportunity zone, a hotel project right now? Possibly not, but a housing project or an industrial warehouse project might be more appealing. And so another aspect of these opportunity zones too is the jobs that they create, and that's also a consideration. So I wanted to go back to something that Kevin mentioned, which was he mentioned briefly 1031 exchanges, and this is for either Matt or Kevin, whoever wants to answer it. But I'm wondering if either one of you could tell me a little bit about, as an investor, which path, opportunity zone or 1031 exchange, is right for any investor, and how do you know?
Sure. So there's two basic considerations when you're trying to decide between a 1031 exchange with capital gains and an opportunity zone fund. The first one is that a 1031 exchange is just for real estate. If your capital gains come from a stock investment, for example, you can't use a 1031 exchange. A like-kind exchange, that wouldn't be a like-kind investment, a stock to a real estate investment. So that's consideration number one. So obviously, if you're sitting on gains from anything other than real estate, a 1031 exchange is out. The other consideration, this is a big benefit of opportunity zone funds over 1031s, is that opportunity zones allow you to actually eliminate some of your capital gains, whereas 1031 exchanges just allow you to defer them. Liz could probably correct me on this if I'm wrong, but if I think if your opportunity zone investment is held for 5 years, you get to excuse 10% or exclude 10% of your deferred capital gains completely. And after 7 years, I believe it jumps up to 15%. So, all right, she's nodding, so that's correct. So that is kind of the big benefit. Instead of just being able to kind of kick the can down the road, if you will, there's some of that with an opportunity zone, but there is some element of eliminating taxes entirely. And a lot of people, not necessarily in 2020, but a lot of people over the past few years with the record long bull market in stocks have been sitting on some pretty large capital gains. And a big reason they haven't wanted to sell, stock positions that have doubled or tripled is because they don't want to get hit with that giant capital gain tax bill. This was when we started our mogul service about a year ago. This was one of the biggest questions we got, was from investors who were sitting on mountains of capital gains and didn't really want to pay a giant tax bill, and who could blame them? So it's not always 1031 exchanges are not always a great option, especially if you're not comfortable investing in individual properties. A 1031 exchange, it's tough to do with a fund. You generally need to actually buy a physical property, and that's I could tell you firsthand that's not for everybody. So
excellent, thank you. So I wanted to get a little bit more into how this works, the step-up basis versus the capital gains that are deferred. So Liz, I was wondering if you could explain exactly how that works.
Sure. Matt did a great job explaining kind of the deferment of taxes. So if you have your investment, the qualified capital gains rolled into the opportunity zone fund, and it's held for a minimum of 5 years, it reduces your cost basis. So what that means is you actually lower the amount of taxes that you have to pay. So we have great examples for numbers. I don't want to throw numbers out here and misquote, because it definitely does take precise calculations, but it can significantly reduce the amount of capital gains that you are paying on. Now, if you go beyond 5 years, like he said, it goes up to 15%. So your cost basis is reduced by 15%, then you're taxed your capital gains on that amount. Now, if you go even longer, it kind of steps up from there. If you hold the investment in the fund for a minimum of 10 years, you still get your 15% step-up basis, reducing your cost for the capital gains tax. But any capital gains that you made on the investment from the Opportunity Zone Fund specifically you don't have to pay capital gains tax on that at all. So that's an incredible benefit. Obviously, the longer that you have your investment in an Opportunity Zone Fund, the better it is for you, the more bang for your buck, per se, that you're going to get by reducing your taxes, which is an incredible opportunity through these funds. So that's really how it works. It sounds complicated, but when you break it down, it can just reduces your tax burden and potentially defers or reduces taxes altogether.
Well, I think that's something that is exciting too, is that the idea that you can invest and basically any of the gains you make in the project itself, are you don't have to pay taxes. That's kind of amazing. And so I think one of the things that makes that really important then is choosing that right project, is because it's not only that you don't have to, that you get that tax deduction and you get to defer, it's also the benefit of choosing a project that could make you a significant return in the long run. So in terms of how much in capital gains you have to invest, Kevin, I wanted to ask you, how much do you think a person should start thinking about in capital gains to kind of make this type of investment worthwhile, given that it's such a long hold?
I mean, I don't think somebody necessarily has to have a lot of capital gains before it could be beneficial. If you're already looking at a real estate fund to invest in, I mean, the opportunity fund has his tax advantages, but I mean, it's also real estate investment as well. So, it has that benefit on its own. So I would say if you're already looking at a real estate fund to invest in, if you already want to park some money, then, I mean, whatever you have in capital gains, that's just a bonus. If the whole point is to defer the capital gains, then, I mean, it'd have to be, I think, a significant amount. I think most people that are getting into this for this purpose, have to be looking at six figures or more to justify parking your money that long just for the sake of saving on your capital gains taxes.
I'd also just like to add that, or if an investor is truly trying to reduce their tax burden, six figures is great. The more you can invest into a fund, the better. But a lot of the funds are going to designate their minimum requirement. Some of them won't take less than 100,000 or more at a time. So a lot of big players are getting into this because of that reason. But don't discount that if you're a smaller investor. Even if you have $25,000, $50,000 to invest, I mean, if you're saving anywhere from 30 to 50% of your tax basis because of the step-up basis, I think that's a worthwhile opportunity. But the fund itself will ultimately kind of tell you if you can participate or not.
I do want to step back real quick, if you don't mind. I want to kind of steal this opportunity to maybe ask Liz something that I was, kind of unsure about before. I noticed, Liz, you said about with the fund, 50% of it needs to be, in that opportunity zone property. And I know there's some other rules about, there's a 70% rule, a 90% rule. And, my involvement has always been a little bit less on the technical, I guess, piece of it, and more just in the actual development. So, if you know that, I would love to maybe finally get some clarification on what those differences in those rules are.
So the differences change frequently, or I guess I wouldn't say the differences, the clarification that is provided on these rules change. When opportunity zones were first rolled out, there wasn't a lot of guidance. It was kind of a lot of gray area still around them. And then slowly, as things progressed, they started to clarify more and more. And so initially they said that at least a minimum of 50% of activity, or which again, that's a very broad term there. That could include not necessarily where your headquarters are based, but a number of employees, or where the products are being sourced from. So it just had to have at least a minimum of 50% of core activity coming from that area. I believe there's been further guidance kind of clarifying that more, but I do know a lot of those opportunity zone funds that started in the beginning were really following that rule as their guidance. So you'll notice if you do go to the EIG map, you'll see there's funds that are investing in, let's say, a lot of rural areas. This is rather common, especially in the field for like renewable energies, which is a popular sector for opportunity zone funds, you'll find that their base for where their headquarters are is not where an opportunity zone fund is located, but because all of their activity is in those areas, it still qualifies for that. So it depends on the rules. You could also be technically investing in a company or a corporation that's in an opportunity zone fund, rather than you being investing in a project like real estate, like a hotel, for example. So there's all different ways to participate, and the funds are very diverse in their participation in those markets because of that. Did that help clarify more?
It did, yeah. So basically, I just keep leaving that stuff up to the to the accountants and everything on the the team to make sure the money is going where it needs to be.
Yeah, that's always a good idea. Let the experts in that field kind of take that over. Make sure you're following, crossing your T's, dotting your I's. An accountant or attorney is definitely the one to do that for you. So.
Well, I think that's an important point too, is that there are a bunch of different tax forms that you have to fill out if you want to participate in opportunity zones, and also if you want to, designate those capital gains in that. So that is definitely one reason that you do want to let a CPA or a tax professional guide you in that, because they have to keep track of all of the regulations. And Liz, you made a really good point, which is when these first came out, there was so much excitement and there was so little guidance. And then gradually over time, there were a couple of different major releases of rules. I know there were a couple of periods of time where it was open for feedback and questions, and then they released another batch of rules and then kind of have gone through that process. And now it seems like they're pretty much finalized. I mean, nothing in government is ever final, but it seems like right now they're pretty much finalized, at least for the time being. Is that correct?
I mean, kind of. There's always different guidance coming out. Like right now, they actually recently allowed banks to start participating in opportunity zone funds. Prior to this summer, that wasn't allowed. So they also just amended the timeline for you to roll qualified capital gains into an opportunity zone fund for this year. So I think, especially with what's going on in the current climate in our economy, a lot of modifications may come from this. There's always a possibility. For right now, there's a deadline for 2026 for opportunity zone funds, for kind of like the benefits that are associated with them. They expire in 2026, and there's potential talk, depending on what happens in the next election, who we have as our policy leaders. So things could change. They could extend those dates. They could cut them short. So we never really know, but right now it seems rather firm.
Excellent. Thank you. Yeah, I've heard that they probably won't cut them short, but what we may see is extensions. And I think one of the things is that we're seeing the opportunity zone impact sort of being very carefully monitored. And so we've talked a little bit about those 8,700 neighborhoods, and that obviously is a large part of the country, and it also is a lot of different types of neighborhoods. A lot of it is urban, a lot of it is rural. So one of the things I wanted to discuss with all of you is sort of how that's starting to play out, and whether or not we're seeing more activity in urban neighborhoods or rural. Most of what I've seen in the research so far has been that it's been a lot of urban activity, but I feel like with COVID-19, we're starting to see more interest in suburban and rural areas, so that may extend to opportunity zones.
Yeah, for sure. Well, it makes sense why it's been urban for the time being. I mean, when you're thinking about some of these projects, as Kevin mentioned, the average person who's investing in an opportunity zone has like a 6-figure capital gain to invest. So they need to find projects that can accommodate a lot of investor capital, like, a high-rise apartment building or a hotel or an industrial warehouse, which you're just going to find more opportunities to build those. No pun intended. More opportunities to build those in, urban areas. I mean, if you build a suburban apartment complex, it might not be a big enough project to accommodate all the investors who want a piece of it. So that's been a consideration, but I could definitely see that branching out. I'm wondering if the others think that I tend not to believe in the long lasting rural effect of the COVID pandemic as much as most people do. So I'm curious to see what the others on the panel do.
I'm not going to comment.
That's probably the safe move.
Yeah, politics, COVID, I was just going to stay out of it. But I add, I've seen some pretty amazing turnarounds in some neighborhoods and cities with the opportunity zones. I live in Michigan, and Detroit, an amazing example. There were, I remember a few years ago, there was this particular neighborhood that was just known. I mean, just don't walk down there. We had to stand at the other end and get an Uber to get through. And then last year, we were down there, and my wife, her friends, it was actually for a wedding. They were getting Airbnb, and the property was in this area. I said, no way. So well, you guys see the pictures. It's really nice. We went down there, and it's a completely different neighborhood. People made a ton of money on some of the real estate they held on to during the, from beforehand. And, here locally where I live, there's a particular neighborhood that, is just, as long as I've been alive, has just been known as just, not a good area. All the buildings have become vacant, a lot of crime. And, it's been really cool watching this over the past few years, turn around. I think where, developers, they didn't want to put their money into an area like this, because, I mean, the value just was never going to be there. It didn't make sense. And the first one I saw go up, I remember thinking, why in the world would, this guy stick his money here? But over the last, since then, you could really see why a lot of these, old, dilapidated buildings are now, now beautiful apartments. They're, mixed use. There's new businesses going in down there. This one particular corner that was tore down because, things had just gotten so nasty there, now has a department store, in there. They've got, again, apartments, condos, some of the most expensive apartments in the city actually are in this area that, you couldn't have paid me to live in before. So definitely seeing a lot, seeing the this opportunity zone initiative work all around.
I'd love to speak on the rural side of things, kind of give a different perspective. I would agree that most of the projects that we've seen are going to be in urban areas. And Matt pointed to that perfectly. There is more technically opportunity in those areas for investments, for development. You're taking on more risk when you go to a rural area that might not have the demand or the opportunity to hope to see their vision come through, right? If there's less people there, just because you're creating an opportunity or a new development project doesn't mean people are going to go there. So I do think there are a lot of rural developments that are happening. They're just a lot more on the agricultural or sustainable energy side of things. So there's a lot of renewable energy projects that are a part of the Opportunity Zone funds. There are also a lot of agricultural projects, including sustainable regenerative agriculture, which I think is really cool. It's a sidestep from a lot of the large agricultural REITs that you might see or stocks that you can invest in. And they're taking a different approach to gain the tax benefits available for them, but also to kind of take a social charge, make a positive change. So I definitely think there's both activity. I just think they're very different projects in those fields.
Liz, I guess, I haven't really studied where some different ones are. I know I look at specific areas, say where in this area are there opportunity zones. To be honest, I've never really thought to look out in more rural areas, but is that pretty common to see some big tracts there that, have these opportunities?
I definitely think so, but they're mostly in the same subsectors, right? There's not many apartment developments or hotel projects or retail side of things outside of those urban hubs. Those types of investments, I think, are really concentrated into about 10 to 15 core markets on top of that. LA, Orlando, you mentioned Michigan, so Detroit's a big one. What's the Cleveland, Ohio is another big one. So there's definitely just core hubs for those types of projects. But if you look outside of that, there's definitely some really creative and unique projects happening in the rural areas as well.
Thanks.
Yeah, a lot of rural areas, it's relatively easy for them to qualify as an opportunity zone, because if you remember, they're not going to qualify usually based on the 20% poverty rate rule. But when it comes to that 80% of the income of surrounding areas, rural areas are generally not the highest income places. So you will see a lot of opportunity zones in these rural areas. And Liz kind of hinted at a really good point a minute ago when she said, just because you can build something in a rural area doesn't mean that you should. Just because something is an opportunity zone investment doesn't make it a good investment. You still need to do your due diligence. It still needs to, make sense, as if, even if it weren't an opportunity zone, it should make sense. If you build a self-storage facility in the middle of, New York City, you're not going to have any shortage of demand. If you build it in rural South Carolina, where I live, is it going to fill up? Maybe, maybe not. That's something you need to do your due diligence on.
It's really important to see how that market has been affected from going on currently. There was a recent study done by the EIG group, and they found that about 52% of funds stated that COVID-related challenges have created setbacks for their fund. They've been negatively affected in some way or another. And some of that is just slowdowns in construction permitting. Construction kind of came to a halt at the start of the pandemic and has definitely picked back up pace. And I think a lot of projects are back on track now, where that negative impact isn't necessarily a long-term impact. But there's definitely going to be some sectors that, when they launched their fund, it was a great project and it was a great investment opportunity that may be negatively impacted for quite a while. I mean, I take a long-term look at the real estate market, and I always think everything happens in cycles and things will recover. But what might have been hopefully a 20% projected ROI is now a 5% projected ROI, or, those are just loose numbers, but that's definitely something to take into consideration. It's especially right now due to its narrative.
I agree there. I think, you get some, certain buzzwords like opportunity fund. I think some people might be a little more, quick to, put their money into some of these, maybe without the same due diligence. And, there's one issue that I've come across on this end is, a particular developer, he had quite a few projects going on, and he just gotten into this, into the opportunity zone type of development, and he just kind of fell flat on his face. He just was anxious to pick an area, got a good deal, got a good price on it, and had built something where I guess he shouldn't. And people were quick to put their money into it. I think it was the fastest raise he'd ever done, and he's still hopeful that they were going to kind of get it put back together, but yeah, definitely just because it's opportunity zone and it's a good price and everything sounds exciting, isn't a guarantee that things are going to go well.
I think that's really true. And I think that's one of the reasons that we did some research on Millionacres. We did the fastest growing opportunity zones. And one of the things that we did was look at not just look at some of the underlying demographics, some of the underlying fundamentals, and see what is driving, what is the unemployment, what other businesses are in the area. So I think when you're looking at opportunity zones, you want to look at, of course, the individual project, what need it serves, and what the potential growth is, but you also want to look at the overall neighborhood and the overall demographics for the area. And I believe that one of the things, not to go too far on the rural versus urban thing, but I believe that one of the things that we're seeing is this sort of opening up of different areas with working from home. We're seeing some companies are, letting people work from home. So we're seeing this sort of expansion of companies thinking of being perhaps a little more decentralized and less just on corporate campuses. And that may unlock some different opportunities as well.
Even both on the, developer, somebody starting the fund and somebody investing in the fund is really important to look at that. Like I said, with the other one, you just put a nice building in in the middle of a bad area, and it's, it's not going to work out. It has to be, there kind of has to be a master plan, whole grand scheme there. And if you're just, you look at it, you got a $5 million project, start a fund, raise $5 million, do that project, and hope for the best. It's not going to do a lot. That whole area really has to have a plan for it. And I think, hopefully a lot of people that will be starting a fund or a developer would realize that somebody ready to invest into a fund really needs to look at that. I think, like you said, what else is that developer going to do? Who else might be participating in that area? Because no matter how great that might look on paper, we're going to build 200 units apartments, is it's going to rent for this much, and they might look great, but without that surrounding area being redeveloped, it's all for nothing.
And I know that recently it came out that the White House announced that $75 billion had been invested in opportunity zones so far. So that's significant in a relatively short period of time. It's just been it's less than 3 years, and so that's obviously there's been a lot of enthusiasm. Some people have said that they thought the program would be larger than that. Obviously COVID-19 has had an impact, but I wanted to talk to all of you about what you think the future of the program will be. We talked a little bit before about it potentially being extended. One of the things I've seen people talk about is, will they create more opportunity zones, or will the opposite happen where they start looking at some of the zones and saying, okay, maybe this zone isn't eligible anymore if it's grown too much. So want to know what all of you think about what the future could hold for this program.
I'll go ahead and say, I think the $75 billion figure, whether that grows at a faster rate or not depends on how many people have capital gains to invest. What I mean by that is, if you think over the last 6 months, has anybody really had capital gains? I know my portfolio really hasn't. I'm kind of back to even right now, but it depends. The point being, if the stock market, goes up by 20% next year, you're going to see a lot of people with capital gains they need to put to work. If the average home price in the U.S. goes up by 5 or 6% next year, you're going to see a lot of investors with excess capital gains they need to put to work. So it depends on how well our investments do, first of all, but it's a pretty popular program so far, and for good reason. And I guess it's going to depend on how it's actually helping. If it's achieving its intended objectives is really what it's going to come down to. Obviously $75 billion, people are getting some major tax breaks on this, but is it really helping these neighborhoods? And I know that's a topic for another podcast, but it's going to come down to all the information that we have on whether or not it's actually achieving its objective.
I think you summed that up perfectly. I think that's a huge factor in if we'll see more activity in this or not. And I think it's just too early to see. Development projects take time. A lot of this is redevelopment or repurposing of existing buildings in blighted areas. Sometimes it's developing a ground up project, and those take time. So until we can actually see and test and find data on the not just profitability of the project, but the ultimate success in its original objectives, I think that's going to be the biggest factor there. I also don't know that they'll expand the census tracts. I think until we get more data, I see this kind of staying pretty firm. unless we do see a large market swing that needs to incentivize more activity into more areas. And then if we do see that big turn, I wouldn't be surprised to see them make adjustments. But right now, I don't see that being very likely.
I imagine that, it hasn't been around for that long, so I don't think anytime in the near future we should see it go anywhere. When you look at like the Section 179, bonus appreciation, these, temporary tax advantages, like how long those have been extended and stayed available. And not to get political or anything, but I know there's his talk of like the like a 1031 exchange, the future of that possibly being on the table, depending on the outcome of the election. And if the opportunity zones aren't put on that chopping block as well, then this would be one of the only available deferral strategies left. So it could really turn into a huge thing, but hopefully it doesn't become so big that they want the tax revenue back. So.
Well, I think that's a good point. I think Liz, you're right, because the original program was set to, there's that 2026 deadline. And so I feel like at that point, that sort of becomes that natural inflection point where there's going to be enough data that everyone can go back, look at it, see what the program has done so far, and then figure out what it can do in the future. And so I wanted to also ask all of you what other resources you've been looking at for opportunity zones. Liz, you mentioned the EIG. I've looked at Novogradic has a lot of information on the funds that have come out and keeps track of how many opportunity zone funds there are overall. Are there any other resources that any of you are finding really helpful?
Well, I can mention that I've seen on some of the major crowdfunding platforms, they have a lot of opportunity zone funds. And I like this, especially for people who aren't really comfortable with evaluating real estate investments yet, because these are very highly vetted projects. Especially the really reputable sites, they do their homework. So that's a good source to look for, especially if you are relatively new to real estate investing.
Absolutely, I agree with that. Mostly what he said as far as these projects being vetted, between the crowdfunding sites and and seeing what's going on in your community. Depending on if you are investing in real estate locally. These new funds usually make, some sort of headlines. There's talk of them locally. So if it looks like a good project, you can kind of get a double benefit there, profit from the fund. And then, if it's helping your real estate values. So, between looking for some of the best opportunities out there, definitely the crowdfunding sites, but definitely keep an eye on your local market as well. Like I said, get that. It's always good to help your own community and profit from it as well. So
I love that. I think that's actually kind of a nice place to wrap this up. And so thank you, all of you, for your time.
Thank you.
Of course. Thanks for having us.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. And if you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discuss, and Millionacres or The Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.